I want to tell you something that George Soros drilled into me back in the 80s that I still think about almost every single day. He used to say that it doesn't matter whether you're right or wrong. What matters is how much money you make when you're right and how much you lose when you're wrong. That's it. That's the whole game. And I'm bringing that up right now because the SpaceX IPO conversation that dominating financial media is setting up exactly the kind of situation where most people are going to get the direction of the story right and still lose money. And a smaller group of people who are thinking a step ahead of the crowd are going to make a lot of money in names nobody's talking about yet. I've spent my career trying to be in that second group. Today, I want to show you how I'm thinking about this. Now, I've been doing this for over 40 years. I ran Duquesne Capital for 30 years. We never had a losing year, not one. And I'm not saying that to impress. I'm saying that because the approach that produced that track record was never about being the loudest voice in the room or chasing whatever story was on the front page of the Wall Street Journal. It was about doing the work early, understanding where capital was going to flow before it got there, and then having the conviction to seize the position appropriately when you were right. That's the framework I'm going to apply to the space sector today. And by the end of this, I want you to understand not just which stocks I find interesting, but why I find them interesting and how to think about risk in a sector this early and this volatile. Let me start with the macro picture, because that's always where I start. You cannot understand an individual stock without understanding the larger capital flow environment. It's sitting inside right now the United States government through the Department of Defense and through NASA is making a multi-decade commitment to space-based infrastructure. This isn't a trend. This isn't a theme. This is a structural shift in how the federal government allocates capital. And when the federal government makes that kind of commitment, it creates long, durable revenue streams for the companies positioned to capture them. That's the kind of tailwind that serious investors get paid to identify early. The space economy today is roughly $500 billion. Most credible projections have it approaching $2 trillion by 2035. Now, I hold forecasts loosely. I've seen enough economic projections fall apart to know humility is warranted. But the direction here seems right to me, and the structural reasons behind it are sound. Here's what I think most people are getting wrong about the SpaceX IPO. And I want to be precise about this because it matters enormously for how you position yourself. SpaceX is a genuinely extraordinary business. What Elon Musk has done with reusable rocketry is something the aerospace establishment said couldn't be done at that cost. Starlink is a cash machine with a global addressable market that is almost incomprehensibly large. If you told me SpaceX will become the biggest company in the world in 20 years, I wouldn't argue with you. But here's the problem, and this is where I've seen intelligent people make painful mistakes over and over again. The quality of the business and the quality of the investment are two completely different questions. And at a $2 trillion valuation, an enormous amount of that extraordinary future is already priced in. Think about it from a capital flows perspective. SpaceX has been private for over 20 years. The venture funds and private equity funds that backed it early have made somewhere between 50 and 100 times their money on paper. That money's locked up. The IPO is the mechanism by which they unlock it. I've been on both sides of this trade. The IPO is not designed to generate returns for retail investors walking in on day one. It is the exit for the people who took the early risk. Wall Street calls retail investors in that situation exit liquidity. That is not a flattering term, and you should understand what it means before you hand over your capital. And there's a mechanical issue on top of the valuation issue. 6 months after the IPO, the lockup period ends. Every institutional investor who's been sitting on gains for years suddenly has the ability to sell. I've watched this happen dozens of times. The stock doesn't have to be a bad business for the price to get hit hard. When that lockup expires, it just has to have impatient sellers meeting a market that's already digested the initial excitement. That 6-month window is where a lot of retail investors who bought the IPO start feeling real pain. Now, SpaceX might be different. The business is genuinely strong, but I would be very careful about the entry point, and I would be watching that tape closely around the lockup expiration. So where does that leave us? It leaves us looking at the companies that are already public, already past their own IPO paying, already building the physical infrastructure that the entire space economy depends on, and in most cases still valued at a tiny fraction of what they could be worth if the space build-out plays out the way I think it's going to. These are the names I want to walk you through. The first one is Redwire, ticker symbol RDW, and when I frame this company, I want you to think about something that happened during the semiconductor build-out of the 90s, when it became clear that computing was going to transform the global economy. There were two kinds of ways to invest in that thesis. You could try to pick which software company was going to win, which was genuinely hard to know, or you could buy the companies making the equipment and components that every semiconductor manufacturer needed, regardless of who won the software wars. Applied Materials, Lam Research, KLA. Those companies made extraordinary returns because the demand for their products was structural, not contingent on any single winner emerging. Redwire is that kind of company for space. They build the hardware that every spacecraft needs: solar arrays, antennas, sensors, structural components, robotic systems. They even have 3D printing technology operating on the International Space Station right now. It doesn't matter which launch company wins the next decade. Every satellite, every space station, every lunar mission needs power and communications and navigation. Redwire built all of that. The catalyst structure here is what I find compelling. NASA's Artemis program needs hardware for lunar missions. The Department of Defense is accelerating its space-based capabilities significantly, and that budget is growing. Most importantly, private companies, including Axiom Space, Blue Origin, and Voyager, are building commercial space stations to replace the ISS, which is being retired around 2030. Redwire is a natural supplier to all of them. 60% of their revenue comes from government contracts, which provides a stability that early-stage space companies rarely have. This is a $2 billion company. If they land meaningful contracts with the commercial station builders, which I think is more likely than not, this is a very different company at a very different valuation. The stock has been under pressure. I don't mind that. I've made some of my best investments in companies that the market had given up on while the underlying business was still quietly improving. The tape has been showing me institutional accumulation in this name, and I am pay attention to that. The second company I want to discuss is Voyager Space, ticker symbol VOYG, and I think this is the highest upside name in the group, with corresponding higher risk. What they are attempting is bold in a way that I genuinely respect. They are building a commercial space station called Starlab in partnership with Airbus, and they are one of the primary contenders to replace the International Space Station. Now think about what that means from a business model perspective. The ISS has been continuously occupied by humans since the year 2000. NASA does not want to lose that capability. They have been clear that they intend to rely on commercial operators to maintain a human presence in low Earth orbit after the ISS is decommissioned. Whoever wins that position has a customer in the United States government that will pay for access to that station for decades. That is a durable, contracted revenue stream of a kind that almost never exists for a company this size. What I particularly appreciate about how Voyager has constructed their business is that they're not running purely on venture faith. They have real defense revenue coming in right now from missile defense systems, hypersonic missile components, radiation-hardened communications equipment. The defense business funds their operations while Starlab is under development. It's a smart capital allocation structure for a company in this position. The risk is real, and I want to be honest about that. Building a space station is among the most technically challenging things human beings have ever attempted, and things can go wrong, but the risk-reward at current valuations, given what this company could be worth if Starlab reaches operational status, is the kind of setup that I find genuinely interesting. Now let me tell you about Firefly Aerospace, and I want to start with a fact that I think is underappreciated by most investors who follow this sector. Firefly has landed on the moon. A private company from Austin, Texas has successfully landed a spacecraft on the lunar surface. That puts them in the company of the United States government, Russia, China, and India. As an engineering credential, that is not a small thing. And yet this company trades at a valuation that suggests the market hasn't fully absorbed what that achievement means for their credibility with government customers. Their Alpha rocket is a small lift vehicle bringing satellites to orbit at competitive economics. They're developing a medium lift vehicle called MLV that goes after larger payloads. But the specific capability that I think the market is undervaluing is what the Defense Department calls responsive launch. The military wants the ability to put a satellite over any point on the globe within days, not months, if a threat emerges. Firefly's rocket is designed to deliver exactly that. When the Department of Defense wants a specific capability and doesn't want to depend on a single provider, they fund multiple companies. Firefly is one of those funded providers, and that position is difficult for a competitor to replicate quickly. The revenue growth has been accelerating meaningfully. They have a reasonable cash position for a company at this stage of development. This is not a risk-free investment, but the technical credibility is real, and the government-customer relationships are real. And those are the two things that matter most in this sector. The fourth name I want to discuss is one where I'm going to be unusually direct about the risk profile, because I think it's important for you to understand exactly what you're looking at. Orbit International, ticker symbol OBT. This is a $13 million market cap company. Let me be very precise about what that means. This is a microcap name that institutional investors cannot meaningfully participate in because the liquidity simply isn't there at that size. The stock has been essentially dormant for years. These are not the characteristics that a conventional portfolio manager would find attractive, and I want you to understand why I'm mentioning it anyway. What Orbit International builds is mission-critical electronic components, ruggedized human-machine interface devices, keyboards, displays, control panels, engineered to survive battlefield conditions, airborne conditions, space conditions, power supplies built to military specifications. These are the components that go inside defense contractor hardware, into satellites, into spacecraft, into ground control systems. The customer base is the defense industrial complex, which is increasing its space-based expenditures significantly. The math that makes this interesting is structural rather than certain. If a company with $25 million in annual revenue doubles that to $50 million, the percentage move in the stock price for a $13 million company can be extraordinary because you only need one meaningful buyer, one hedge fund, deciding to take a small position in a company this illiquid can move the price dramatically. Now, I want to be unambiguous. This is a highly speculative position. This is not something you size at 5% of your portfolio. This is something you take a very small position in with money you can afford to lose entirely. As part of a diversified approach to the space theme, the potential is asymmetric, meaning the upside relative to the amount you risk is potentially very large. But asymmetric potential is not the same as probability, and you should not confuse them. I want to take a step back and talk about how I think about position sizing in a sector like this, because I think it's as important as picking the right names. And when I was at Duquesne, I didn't make money by being right on every idea. I made money by being right on my biggest positions and not losing too much on the ones that didn't work. In a sector this early and this volatile, you want a structure, you want a core position in the least risky name. For me, that's Redwire, which has government revenue, real products in space right now, and a manageable balance sheet. That's the anchor. Then you have a growth position in something like Voyager or Firefly, where the upside is larger and the risk is correspondingly higher. And if you have the risk tolerance for it, a very small speculative position in something like Orbit International size, so that if it goes to zero, it doesn't affect your financial life in any meaningful way. That kind of structure lets you participate in the asymmetric upside of the sector without putting yourself in a position where one bad outcome destroys what you built. One more thing I want to say about timing, because I think it's relevant to how you approach this. The SpaceX IPO is going to suck an enormous amount of capital into this sector when it happens. Retail investors, institutional investors, sovereign wealth funds, everybody is going to want a piece of that story. And here's what I've observed consistently over 4 decades. When a dominant company in a sector goes public, it raises the visibility of the entire sector. It brings new investors in who didn't know where to look before. And those new investors start looking at what else is available in that sector. The smaller, already public companies in the space ecosystem could benefit meaningfully from that visibility effect, because right now most of them are being ignored. The narrative around SpaceX is going to make space investing mainstream in a way it hasn't been before. That's a capital flow dynamic that I think could be very favorable for the names I've described. I also want to say something about patience, because I think it's undervalued in a market that increasingly operates on very short time horizons. The space economy is a decade-long thesis. The companies building this infrastructure are not going to be worth 10 times what they are today in the next 6 months. Some of them might not even be worth more than they are today in the next 6 months. Markets are unpredictable in the short run in ways that humiliate people who think they can forecast them. What I'm describing is a structural shift in how governments and private companies are allocating capital. And structural shifts take time to play out. The investors who make the real money in situations like this are the ones who do the work early, size appropriately, and then have the discipline to hold through the inevitable volatility without panicking out of positions at the wrong moment. The volatility isn't a problem. It's actually where the opportunity comes from, because it's what keeps most people on the sidelines or forces them out of positions before the real returns materialize. I've made mistakes in my career by being too early. I've made mistakes by being too late. I've made mistakes by sizing positions incorrectly. What I've never done is regret doing the work before everyone else was, paying attention. The most important thing I can leave you with is this. The time to study a sector is before it becomes the thing everybody is talking about. Meanwhile, a small group of companies that are already public, already building the physical infrastructure of the space economy, are sitting there at valuations that assume much of this doesn't work out. That gap between what these companies are worth if the space economy develops, as I expect, and what the market is currently pricing them at, that's where I see the opportunity. I can't tell you exactly when the market recognizes it. Nobody can. What I can tell you is that in my experience, when a structural thesis is right and you've positioned yourself correctly and you have the patience to hold through the noise, the market eventually figures it out. And that's generally when you get paid. Do your own work. Understand the risk. Size your positions accordingly. And don't let the excitement around the biggest IPO in a generation distract you from the quieter, less glamorous opportunity that's sitting right in front of you.